let me tell you how it will be. There's one for you, 19 for me. 'Cause I'm the tax man. Yeah, I'm the tax man. Should 5% appear too small? Be thankful I don't take it all. 'Cause I'm the tax man. Yeah, I'm the tax man. If you drive a car, I'll tax the street. If you try to sit, I'll tax your seat. If you get too cold, I'll tax the heat. If you take a walk, I'll tax your food. Tax man.
Hi everybody, welcome back to Econ 202. Now we're into Unit 6, which is a fiscal policy unit. We are in the home stretch here, Unit 6 and one more unit to go. And what we're going to be talking about here is fiscal policy. Okay, we've talked about monetary policy. What can monetary policy do, manipulating the money supply to impact business cycle and macroeconomic stability. Now we're going to look at fiscal policy, which deals with taxes and government spending. And what can that do, if anything, to help with the business cycle, unemployment, and macroeconomic stability. First off, let's just get some basic definitions, kind of introduce these concepts. Fiscal, the term fiscal comes from the Latin word fiscus, which means a state treasury. So anything that's fiscal means relating to the state or the government treasury. So we're talking about government funding. Government has to collect taxes or borrow money to fund its operations, and then government spending, of course, the various programs and projects that government spends money on, like the military, like educational grants, federal courts, law enforcement, social security, so on and so forth. Okay. Fiscal policy then is basically what the government does. Government's policies set by the Congress and the President and the other governmental policymakers regarding both taxation on the revenue side of public treasury and spending, of course, on the dispersing the funds side. And specifically what we're looking at with fiscal policy in the modern era is looking at manipulating tax policy, so changing tax rates and using government spending as a tool to stabilize the economy, to try to prevent or minimize the effects of business cycles, to try to minimize unemployment, to try to promote economic growth and that kind of thing. Okay, what we'll do to start out with, and you'll note here that this particular lesson corresponds with chapter 17 in the book, which just covers the facts and figures about government tax collection and kind of the basic outline of the federal budget. Now, before we get into talking about details of federal tax collection and federal spending, I want to go through just some really basic fiscal principles with you that'll be useful kind of guide stones for us when we're talking about fiscal policy in general. We're going to take a look at the tax structure of the federal government. What I want us to understand right now is that all taxes are income taxes, and I call this my fundamental fiscal principle 1. Because whether it's levied directly on your income or whether it's levied on your spending, you have to realize that when people are taxed, their ability to spend goes down. In other words, their real income goes down. Okay? We can't get around this. Okay? And there are different incentive effects based on different tax structures, whether you tax people's income or their wealth or their spending. But we're not going to get into that. We're not dealing with the ins and outs of public finance here. We just want to realize that for the government to collect money, it has to take consumption opportunities from citizens. Okay, so we can say all taxes are income taxes. We could just as well say all taxes are output taxes. We could put it in these terms: when the government collects resources, that reduces the available resources for other people in the economy to use. Okay, this is just a fundamental fact. Okay, and by the way, we're not critiquing government spending right now. We'll do a little bit of that later on. Some government services are vital. There's going to be big differences of opinion on what services are important and what are not. But we want to realize that to fund government, there has to be taxes. All taxes ultimately reduce people's real income. Okay, we're talking about transferring resources from the hands of citizens into the use of the government. You might have heard this old chestnut before, common saying in economics, there's no such thing as a free lunch. Okay, we want to keep this in mind when we're talking about taxation. Okay, now let's get right into where the federal government gets its revenue. And this is a nice little pie chart that I got from a handy website called usgovernmentspending.com. And what this does is breaks down by percentage, and I've gone ahead and written the dollar values on here as well, the different tax sources from which the federal government collects its revenue. First off, we'll look at what's labeled income tax, and that is the bulk of federal revenue here, coming in at 59% for fiscal year 2013. This is a projection for the current fiscal year. 59% of all federal revenue, or $1.7 trillion, is in the form of income taxes. That breaks down into $1.36 trillion in the personal income tax. We're talking about this is your IRS 1040 form that's due every April 15th, the dreaded tax filing deadline. And we're talking an additional about $350 billion in the corporate income tax. Moving on, we have what's called the social insurance tax. And this is 33%, a pretty significant chunk of federal revenue at $960 billion. And what this is, if you've ever had a job and gotten a paycheck, you'll see this deducted from your paycheck, and the line item will say FICA, F-I-C-A, which stands for Federal Insurance Contributions Act. This was legislation that allowed the government to take the money yoink right out of your paycheck for Social Security and Medicare, the government's old age pension program, Social Security, and Medicare, the government's old age health insurance program. Okay, comes right out of your paycheck. Government collects almost $1 trillion. Don't even have to bother getting people to file that 1040 form by April 15th, right out of your paycheck. Okay, the remainder, pretty small. These will be things like federal excises, which are basically sales taxes on things like alcohol, gasoline. There's also some federal service charges. The government runs some toll roads and bridges and ports and things of that nature, and they collect some fees and things of that nature. And then business and other revenue. The bulk of this money here is money that the Federal Reserve remits to the Treasury through the money laundering scam. Through the interest the Fed earns on government bonds. I'll comment a bit on that later. So here's a breakdown of government revenue. And if you add all these numbers up, you'll see that the federal government's going to collect about $2.9 trillion this year, which works out. I mean, these numbers are pretty big, so we want to think about them in terms of another big number that we're familiar with, which is GDP. And currently GDP is about $15.5 trillion or so. And we divide that into GDP, and we find that that works out to 18% of GDP. Now, if you looked at 18% of GDP and you compare that to other industrialized countries, you'd say, wow, the tax take of the government is pretty low. We want to bear in mind, though, that the United States is a federal system. Okay, we've got the national government, and then we've got state governments which collect their own taxes, and as I mentioned, even county and city governments collect some taxes. So to look at the total tax take of all levels of government in the U.S., we would want to add in all those state and local taxes. And if you do that, you find that all government collects about 5.6 trillion here, which adds up to 34% of GDP. Still relatively lower than other industrialized countries, say in Europe, where you've got tax takes of 40 to 50% of the economy, but we're starting to get up there. Okay, so those are the kind of raw numbers on where the taxes come from. Now we want to look at more of a detailed breakdown of who pays taxes in the U.S. economy. The U.S. tax system, at least the income tax system, is what's known as a progressive tax system. And all that means is that those who make higher incomes pay not only more taxes, but they pay higher tax rates, so they pay proportionately more in taxes than people who make lower incomes. And this is what our tax structure looks like right now. We've got two things to pay attention to: a marginal tax rate and then an average tax rate. Marginal, you go way back to Unit 1, we talked about marginal concepts a lot in economics. Marginal, remember, means extra. What the marginal tax rate is, the tax rate on your extra income above a certain threshold. And what those are known as are tax brackets. You can see these down here. how it works is that for your first $16,750 of income, you pay 10%. Okay. So if that is your income, multiply it by 10%. Of course, it'd be about $1,675. That would be your tax bill. Now, any income between $16,750 and $6,800 is going to be taxed at a 15% rate. Okay. And you'll notice your average tax rate will creep up, being pulled up by the marginal rate. Income from $68,000 to $137,000, you're going to pay 25%. Income from $137,000 to $209,000, you're going to pay 28%. Income from $209,000 to $373,000, you're going to pay 33%. Notice 33% of those dollars. Okay. Up to $209,000, between $137,000 and $209,000, you only pay 28% of those dollars in here. Between $68,000 and $137,000, you only pay 15% of those dollars. Okay. So you notice that people's tax burden does grow. Okay. It never quite catches up with that highest marginal rate, which is 35% on all income above $373,000. Okay. You see the average tax rate follows this upward sloping curve. As you make more money, you pay higher tax rates, both marginal and average. Okay. What the progressivity of the tax system means is that people at the top of the income distribution, at the income spectrum, pay the lion's share of federal taxes. Okay. Now, the latest data I could find here from the Tax Foundation was for 2009. Current data is not going to differ that much, though, in these percent terms. The top 1% of all earners, you hear a lot about these people in the news. You hear the Occupy Wall Street people complaining about the top 1%. Okay, be that as it may. I want you to notice here they're already paying about 37% of all the personal income tax. Okay. If we broaden that out to the top 5% of earners, now we're talking about people making $154,000. Okay, so they're well off, but not by no means filthy rich. They're doing 59% of all the personal income tax. Okay. The top 10% are doing 70% of all the personal income tax. The top 25%, now we're talking middle class folks who are making a household income of $66,000. They're paying almost all of it, 87%. In the top half, they are basically paying all the taxes, which means the bottom half is paying very little to no taxes. In fact, if we go add another 3% here, the top 53% is paying all personal income tax, and the bottom 47% has no net tax liability. They actually will typically get a tax credit. They'll get a check back from the government. I shouldn't say back from the government because they're not paying anything in, at least not in terms of personal income tax. Now, go back here to the sources of federal revenue, and notice the social insurance tax, the payroll tax, FICA. Everyone who has a job pays that. So we're not saying that these people aren't taxpayers, okay? And that's a common misconception. And I think one of the presidential candidates in 2012 made the comment that 47% of people pay no tax as well. When you're talking about the personal income tax right here, and when you're talking about the personal income tax, that's true. Of course, those people still have a tax liability from FICA and from other taxes and state and local taxes. So to get a more accurate picture of the overall tax burden, okay, we want to look at state and local taxes as well. We want to look at property taxes, sales taxes. Federal income taxes are by no means the only tax in this country. We will see that the lower income groups do pay a significant amount, although we still see the tax burden is pitched towards the higher income groups. And what we're looking at here is the income percentiles. Okay, actually what we have here is quintiles from 0, the bottom 20%, that's this group right here of earners, the next 20%, the middle 20%, the next highest 20%, and then the top 20% actually would be this whole group right here. Okay, and you see lower income folks pay roughly 17%. Okay, here's a number down here, 17.4% of all their income in taxes. Okay, all across all levels of taxation, federal, state, local, property, sales taxes, etc. And the higher income groups, here's the top 1%, they're paying 29%, the top 5%, the top 10%, the top 20%, they're paying about 30% of their income. Okay. Still a significantly progressive system, but it's not quite as stark as that previous chart made it look. But the bottom line is that lower income folks are paying quite a significantly lower tax burden, about 17% of all their income, and higher income folks are paying about 30% of all their income. Okay, so that's a kind of quick and dirty rundown of how the tax collection and what the tax burden looks like for the U.S. federal government. Now, the next thing we want to take a look at is what the heck are they spending all that money on? Okay, here we're going to do a really brief tour, and I don't want to comment too much about the worthiness of all these different programs. That's really for another day. We just want to look at the raw numbers right now. But we want to do a pretty quick rundown so we kind of have a sense of what this budget is made out of. Okay, total federal spending $3.8 trillion. We're talking a lot of money here. What is it all spent on? Well, let's take a look first off at the big programs. In the big three, first thing I want to draw your attention to, that take up a lion's share of the budget by themselves, is going to be federal health care programs at 24%, federal government pensions, which is primarily Social Security, although there's going to be a little bit of different federal government worker pension programs in there, but the vast majority of that is Social Security, and then military or defense spending at 24%. I want you to notice that these big three programs right here, which again is the government health programs of Medicare, which is for old folks, and Medicaid for poor folks, Social Security, which is retirement income for old folks, and then the military. Together those add up to 23 plus 24 plus 24, 72% of the budget. No, I'm sorry, 71%. Together those add up to 71%. More than 2/3 of all federal spending is on the big three programs. And you can take a look here. It's $879 billion for Social Security, $916 for health spending, most of which is Medicare, $530 billion. A big chunk is Medicaid. Again, that's for poor folks. And then a small chunk here, which is research. Okay, $900 billion on defense. Okay, together those make up 71%. Okay. Next biggest program is going to be welfare, so various government assistance programs for poor people. We're looking at things like food stamps. We're looking at housing subsidies. We're looking at direct government payments. Okay. All government welfare programs. Significant chunk of the budget, but it's 11%. All welfare is 11%. Lots of people have a misconception here, and they think that most government spending is welfare for poor folks. Well, a big chunk of it is, but look, it's only 11%. Okay, that's actually fairly small. Okay. Next biggest we can look at is education. Okay. We're looking at things like federal grants to states and federal grants to students. And then we've got a whole bunch of kind of miscellaneous smaller categories. Protection would be things like Homeland Security, Transportation Security Administration, and that kind of thing. Transportation would be things like government highway funding, government railroad funding, Amtrak, and that kind of thing. General government would be things along the lines of federal courts and the FBI and running government buildings and that kind of thing. Other spending, basically every other miscellaneous thing government does, national parks and in the space program and all that kind of stuff. Here's a category that's going to be pretty important when we talk about the implications of fiscal policy in the U.S. Fiscal problems, which is interest on the national debt. So currently currently the sixth largest government program. It's not a program, but if it were, it would be the sixth largest. Interest on the debt is a significant chunk of money, $250 billion right now. And this is something we want to keep in mind, especially given what is this level of interest rates right now, given all of this extremely aggressive expansionary monetary policy and with the financial crisis. Interest rates are at historic lows. Interest rates are low, and the government's spending $258 billion on interest on their debt. Imagine if interest rates were at kind of more normal historical levels. Okay, that's a little food for thought that you want to keep in mind when we talk about the government fiscal problems. Okay, so we got federal spending of $3.8 trillion. And here's what it's spent on. Again, this is just kind of so you can know the facts and know the outlines of what the fiscal situation looks like. Okay, now hang on a second though. Let me go back here and remind you that we had federal revenue only $2.9 trillion, but here we got federal spending of $3.8 trillion. What's going on? How can the federal government be spending $3.8 trillion when its revenue is only $2.9 trillion? The answer, of course, is that the government runs deficits. the government can borrow money to make up that shortfall between revenues and planned expenses. And that is the definition of the deficit. The deficit for each year is the difference between that year's spending and that year's revenue for the government. And to meet that, to close that deficit, what the government will do is borrow money from investors, most of whom are U.S. citizens or U.S. Financial institutions. A lot of it comes from foreign entities like foreign central banks, foreign corporations, and that kind of thing. Okay, now that's what the deficit is. Now, what the debt is simply the total outstanding borrowings of the federal government that has been accumulating basically since the beginning of the country. Okay, so every year's deficit adds to the national debt, and the national debt has been accumulated for almost 200 years. Okay, the deficit is a 1 year at a time thing. The yearly difference, the debt is the total accumulated borrowings. And I'll show you some figures on both the deficit and debt numbers here in a few minutes, so you can kind of get a handle on the magnitude of these things. Okay, so now that we've got a little preview, and by the way, you don't need to remember any of the numbers for government spending, deficits, debt. You can all of this data is easily accessible on the internet. I gave you one site already, usgovernmentspending.com. Don't need to memorize any of this data. I just want you to get a sense for what the sources of revenue and what the big spending programs are, and kind of get a feel for what the national deficit and debt is. Okay. All right, so moving on, let me address what I call my second fundamental fiscal principle, which is that even though we run deficits, okay, deficits do not belie the ultimate need for taxation. Okay, and we want to recognize that all government spending must ultimately be paid for by some form of taxation. Okay, once again, there's no free lunch here. There's no free government spending. You've got to collect the revenue somehow. And what I want to do is give us just a brief kind of rundown of what the basic fundamental government finance methods are, and this will help to inform our understanding of fiscal policy, and this maybe kind of will help us to cut through a lot of the confusion and debate about the deficit and the debt problem. Okay, because we want to realize that when government builds up debt, it doesn't mean that it never has to raise taxes to pay for that spending. Okay, so let me just give you a quick rundown. There's three things the government can do to collect revenue to finance its operations and its spending. Okay, first off, of course, we have classic direct taxation. Okay, the government raises tax revenue through taxation of current incomes or current spending. Okay, simple, easy, straightforward, easy to understand. And this is what I call the open and honest method. Why? Well, because as we'll see with these other methods, which kind of become a little treacherous, okay, maybe a little dishonest, a little hidden. Direct taxation, say what you will about it, at least it's honest. Okay. The second option, of course, is what we see the government doing now, which if tax revenue does not meet the total planned spending, it turns to borrowing or deficit spending. Now here's the thing about deficit spending. The government borrows money, just like when a citizen borrows money. Those loans, those debts, someday have to be paid back. Okay. How is the federal government going to pay back the loans? Well, there's really only two options. You can use some combination of the two, whether we're talking a private individual or a government. If you take on a large debt burden, there's only two things you can do to pay it back. You can either try to generate higher income or revenue in the future and use that increase in your income to pay down the debt, or if you don't have higher income and the debt comes due, you're going to have to reduce other categories of spending. Now, you might do some combination of the two, but these are the only two things you can do outside of default, which we typically won't talk about in the context of government. You could go into bankruptcy, and ultimately governments can and have done that, but for reasons we'll discuss here in a minute, there's no reason for the government to do that. Okay, so deficits really do imply strictly higher future taxes and or lower future government spending. Okay. Finally, we do know there's an option open to governments to finance their spending operations that is not open to the private citizen. This is something that if you try, you'll probably get caught and wind up in federal prison. Don't do it, trust me. But a government, of course, can do this. It can do it directly, or as will typically happen in our times, it'll do it through the functioning of its central bank. And what we're talking about here, of course, is what the government can do that you can't is print money. Now, I'll probably address the mechanics of exactly how this works in a future lecture. Right now, I just want to put it on the table and make you aware of it. The way this would happen in the U.S. economy with the federal government and the Federal Reserve Bank is somewhat roundabout process, and it's known as debt monetization. But ultimately what happens here is that the Fed will issue new money. Remember, the Fed can create reserves from thin air. The Fed can issue reserves. It'll use those reserves to buy government debt, and then it'll basically refund most of the payments of that debt right back to the government. So it's basically creating free money for the government. Okay. Now, once you're at once you're at the stage of debt monetization, it's usually an act of desperation. Okay. Governments don't want to do this unless they can't raise the money through direct taxation or unless they can't borrow from the regular capital markets. Because what usually will happen when the government's basically broke and desperate is it'll resort more and more on printing money, and it turns to this method of finance. And what this does is creates inflation. We know that printing too much money creates inflation in the economy. Okay. And inflation, of course, is going to cause some economic distress. It's going to hurt certain classes of people, namely savers and creditors. It's going to help others, namely early recipients of new money and debtors. Well, you want to keep in mind here, who is the biggest single debtor entity in the economy? I haven't shown you the national debt numbers yet. You might have an idea of this. It is the government. Okay, the government has a total accumulated debt of $16 trillion. Okay. Now, inflation, as I think we mentioned way back in Unit 3, is a form of tax, because what it does is transfers real resources, remember, from late recipients of new money to early recipients, from savers to spenders, from creditors to debtors, and so on. Okay. Government's a debtor entity. The government is by definition the first recipient of the new money. Okay. What inflation is a tax. Now, the political beauty of the inflation tax is that it's not called a tax and it's not something that Congress has to vote on. Okay, so it's not technically a fiscal policy. Direct taxation up here, the Congress has to vote and the President has to sign off on the current tax structure. Same thing with borrowing. The Congress has to authorize this. But with printing money with inflation, that is not Congress saying we will dictate a 10% inflation rate. This is the Fed, the unelected Fed. And its monetary policy, which most people don't understand, and Congress can try to blame the inflation that results from this on a host of other factors. Okay, but usually when you see high inflation, Milton Friedman says it's a monetary phenomenon, which is true in the immediate sense. It's usually ultimately a fiscal phenomenon in the sense that a government ran out of sources of direct taxation, so it moved on to borrowing. It borrowed up to the hilt, so it ran out of sources of extra borrowing. So in desperation, it went all the way down here and resorted to the printing press the inflationary finance mechanism right here. Okay. Now I'll come back and I'll refer to this listing here of 3 possible government finance sources several times during this unit. But here's the point I want to get across to you right now. Okay. Direct taxation, higher future taxation, or the inflation tax. Notice here, they're all some form of tax. Okay. And what I like to do is label this. Tax 1. Tax me now. Deficit spending. Tax 2. Tax me later. Or inflationary finance, printing money, debt monetization. Tax 3. Tax the purchasing power of my money. Okay. This is it. There's nothing else the government can do to finance its spending. It can do direct taxation, it can do deficit spending, which means future taxation, or it can print money. They're all a tax. Okay. The current tax, the future tax, and the tax on money itself. Which brings me back to this point. All government spending must ultimately be paid for by some form of taxation. Okay. Now you want to keep this in mind. I'll review this a little bit when we talk about we'll talk about fiscal policy in the next lesson. Okay, and when it might be possible to have fiscal policy create positive macro outcomes. But really, what we also want to focus on is that there's no getting around the fact that government spending has to be paid for by some form of taxation. I think that's a very important lesson, so kind of keep that in mind, and I'll come back to that as we move through the unit.
I'm the tax man.